Hello, you're welcome to my channel today. I am Oya Benjamin. In today's video, we are going to be looking at moving average. I came across one of the videos teaching on moving average, and I was taught that the moving average is very simple, that whenever the slow moving average crosses the fast moving average to the downward position, you sell. And whenever the slow moving average crosses the fast moving average in the upward direction, you buy. This is the 50 moving average. Whenever the 20 moving average crosses downward, you initiate the sell order. Sell. And whenever the same 20 moving average crosses again above, you initiate the buy order. And we tried it like that. Sometimes we gained, sometimes we lose. But at the end of the whole thing, in the summary, we lost money. Okay? In trading moving average, there are a lot of things that are involved. Okay, you must have mastered your candlestick patterns. You must have mastered the resistance and the support level. You must have mastered the investment cycle of the markets. Now, you must have mastered these three things before you can be able to trade moving average properly. And these are the things I discovered as I journey in trading. And today, I still use moving average. That is one of my best indicators so far I use in trading because I've understood everything about it. In this video, I'm going to show you how to use moving average to make your entry an easy decision. If you're new to my channel, you're welcome. Don't forget, hit the subscribe button, hit the notification bell, so that as I send video like this, you'll be the first to be notified. And if you're already a subscriber, you're welcome. I appreciate you. Let's go into the business of the day properly. What is moving average all about? Moving average is a price trend indicator. Take note, price trend indicator that takes into cognizance the average of price data point. In a nutshell, this is how moving average works. Okay. Now, if this candle one closed at 1, then the second candle closed at 2, the third candle closed at 3, and the fourth candle closed at 4. The fifth candle closed at 5. Okay, now this is what moving average will do. Moving average will add up the closing position of these 5 candles. We add them up plus 5 equal to, okay, now 1 plus 2, 3, 3 plus 3, 6, 6 plus 4, 10, 10 plus 5, 15. Now this is the total sum of the data point. Now what moving average will do? Moving average will look at the average price of this data by dividing the total number by 5. These are 5 candles, okay? Now you discover is 3. So once it is 3, moving average indicator will plot the 3 on the graph. Now let's go to the class properly. There are 5 types of moving average. We have the simple moving average, we have the exponential moving average, we have the smooth moving average, and we have the linear weighted moving average. Okay. Now, but among these 5, traders mostly use 2 among them. Okay. Other ones are very important, but I've seen traders like me, I use mostly the 2 of them, the simple moving average and the exponential moving average. These are the 2 that are commonly used by traders. Now let's look at the difference. Is there any difference between the simple moving average and the exponential moving average? The only difference is that the exponential moving average reacts more quickly and more closely to the change in price movement. You can see on the chart, I have my moving average. The blue one here is my 50 moving average, and the black is my 200 moving average. Now, I want you to understand, if you are a short-term trader, I would advise you use 20 moving average. Now, but if you are a mid-term trader, a day trader, okay, a mid-term trader, use 50 moving average. But if you are a long-term trader, okay, that you buy, you allow it for a long term, 200 moving average will be the best average for you. Okay, the combination of these moving averages gives you an accurate interpretation in the price movement. Okay, now let's look at how to make a better entry and easy decision using moving average. Now, this is what I do when making my entry decision. Number one, I look at the candlestick pattern formed. It's very important, okay? The candlestick pattern form helps me to analyze my trade, okay? Now, if you look at this point here, you will see what? A bullish pin bar. Some will call it the hammer pattern, okay? Whenever the hammer pattern appears on a chart, after series of downward movement, it tells you that the market is about to do what? To reverse to the upward trend. So once I see the hammer pattern or any of the candlestick pattern recognized, what do? Yes, I wait for confirmation and I enter my market. Just like you can see here, you can see at this point here, look at this point here. You will see that the market has been in an uptrend and all of a sudden an inverse hammer appears here, a confirmation here, a confirmation here. What is it trying to tell me? That this market that has been in an uptrend is about to reverse. So what I do, I enter. After this confirmation, look at it, the first one, the second confirmation, I enter my trade here, then make my profit here. Number two, I look at the market trend at that point. Now, looking at this market trend here, you discover that the 50 moving average and the 200 moving average are interwoven, okay? At this point, that the averages, the moving averages are interwoven, okay, is called the point of indecision. At that point, the market is still deciding on which position to go. Should I go up or should I go down? So at that point, as a trader, it is telling you, wait. The second strategy, you observe the trend, okay? The price trend at that moment, okay? If it is on a consolidation trend, wait. You can see that from here down to here, you see, the market has not really made any decision on where to go because you can see both averages here are interwoven. Immediately after the indecision, the two moving average will start separating apart. Now, at that point, there is gap between the two of them, is a better time to enter the market, okay, depending on the current trend that the market have decided to follow. If the market is in an uptrend, you will know that a buy position will be okay for that market. A sell position will not be okay for that market. Strategy number three, the moving average should be traded with other indicators, okay? Just like you can see, I have my stochastic here to confirm what the moving average is saying. So if I'm trading, I should be able to look at the other indicators that I have, compare it with what my moving average is giving before I enter my trade. On this note, we have come to the end of today's video. Thank you for watching. Don't forget to hit the subscription button, the notification bell, so that as I post videos like this, you'll be the first to be notified. Have a successful trading week ahead. Bye.